In terms of the Canadian Big Six banks, the best performing bank in the fourth quarter appears to have been the Canadian Imperial Bank of Commerce, or as most normal people call them, the CIBC. Hours after publishing their results, the equity is up over 4%, which is the best stock performance of any of the banks this quarter. Why is it up? Let's dive in. Okay, so let's start off with the high level. CIBC in the fourth quarter of 2024 reported net income of $1.9 billion, a 27% increase compared to the $1.5 billion in the same period last year, while earnings per share rose to $1.90 per share versus $1.53 in the year-ago period. On an adjusted basis, net income rose 24% to $1.9 billion, up from $1.5 in the fourth quarter of 2023. Adjusted EPS grew to $1.91 per share, up 22% from $1.57 a share last year. Analysts comparatively had called for adjusted earnings per share of $1.68, which CIBC handily beat. Return on equity also improved during the quarter, rising to 13.3% versus 11.8% in the year-ago period. Well, on an adjusted basis, return on equity came in at 13.4% compared to 12.2% last year. The performance was off the back of $6.6 billion in revenue for the quarter, a 13% improvement over the $5.9 billion recorded in Q4 of 2023, and a beat on analyst estimates of $6.2 billion. For the full fiscal year, CIBC posted net income of $7.2 billion, or $7.28 per share, as compared to $5 billion, or $5.17 per share in 2023. On an adjusted basis, net income came in at $7.3 billion, or $7.40 per share, versus $6.5 billion, or $6.73 per share last year. Return on equity for the full fiscal year came in at 13.4% as compared to 10.3% in 2023, which on an adjusted basis improves to 13.7% versus 13.4% last year. CIBC ended the year with a Common Equity Tier 1 ratio, or CET1, of 13.3%, an improvement over the 12.4% figure reported as of the end of the prior fiscal year. The company also ended the year by announcing a nearly 8% increase to their quarterly dividend, which grew from 90 cents per share to 97 cents per share. Okay, let's get into the segmented data. CIBC, similar to their peers, operates across multiple segments. They currently break out their results into four main segments: Canadian Personal and Business Banking, Canadian Commercial Banking and Wealth Management, U.S. Commercial Banking and Wealth Management, and Capital Markets and Direct Financial Services. Their largest segment, Canadian Personal and Business Banking, reported net income of $743 million for the quarter, a 16.6% improvement on a year-over-year basis, which was credited to higher net interest income as a result of higher deposit margins, volume growth, and higher fees. Canadian Commercial Banking and Wealth Management, meanwhile, saw net income grow a more modest 5%, climbing from $490 million to $516 million in the fourth quarter. Growth here comes from higher fee-based revenue due to larger assets under management, along with higher commission revenue and higher net interest income. Next up, U.S. Commercial Bank and Wealth Management posted the most year-over-year growth across all segments, with net income growing 304% in the fourth quarter of 2024, as they jumped from $50 million to $202 million. This, however, was largely due to the impact of provisions for credit losses, which shrank from $249 million in the year-ago period to $83 million in the current quarter. Finally, Capital Markets and Direct Financial Services saw net income improve from $383 million in the fourth quarter of 2023 to that of $428 million in the fourth quarter of 2024. Growth in the segment was a result of higher financing revenue combined with higher debt underwriting activity. Okay, let's move on to the credit losses. Things appear to be moving in the right direction for CIBC here. Provisions for credit losses in the fourth quarter totaled $419 million, which is down 23% from the $514 million recorded in the fourth quarter of last year. The majority of these losses, or 63% of them, came from the Canadian Personal and Business Banking segment, which recorded losses of $266 million for the quarter. This was followed by the U.S. Commercial Banking and Wealth Management segment at $83 million, while Capital Markets and Direct Financial Services recorded $46 million in provisions, and Canadian Commercial Banking and Wealth Management accounted for $23 million in provisions. The decline in provisions was evenly split between performing and impaired loans, with each declining by 61%. The decline in performing loans was attributed to favorable credit migration driven by paydowns and partially offset by an unfavorable change in the bank's current economic outlook. On impaired loans, the improvement was a result of lower provisions within the U.S. Commercial Banking segment. For the full fiscal year, provisions were largely unchanged, falling from $2.01 billion to $2 billion flat. 60% of these losses, again, came from the Canadian personal segment at $1.2 billion, while U.S. commercial amounted to $600 million in losses, and the final two segments basically split the remainder down the middle. CIBC's gross impaired loans ratio, meanwhile, improved from 55 basis points as of the end of Q4 of last year to 52 basis points in the last quarter. And while we're here taking a look at the state of the consumer lending portfolio, unfortunately, it does not paint a rosy picture for the Canadian economy. Net write-offs in the segment, which includes personal lending, mortgages, and credit cards, have risen from 27 basis points to 35 basis points over the course of fiscal 2024, while 90-day delinquency rates have also risen from 27 to 35 basis points of the loan book, which is despite declining interest rates. CIBC also continues to work towards cleaning up their residential mortgage book, with 11% of mortgages seeing amortizations in excess of 35 years, which is down from 22% this time last year. Lower interest rates combined with renewals have moved the bulk of mortgages into lower amortization periods, however. Okay, so let's wrap it up. CIBC, at least in terms of analyst estimates, was the star of this earnings cycle. With that being said, they still have some work ahead of them. Like their peers, they are suggesting that the Canadian economy is going to get worse before it gets better, forecasting that the Bank of Canada will cut rates by 1.5% between now and mid-2025. Unemployment is expected to rise over the course of the next year, while the country is to face a soft pace of economic growth. This, as per the bank, will pose challenges for some of their strategic business units. Despite the bleak outlook, the stock itself, is doing great. The company rallied on the fourth quarter results, pushing their market cap to $63 billion, while their PE ratio now sits at 13.6 and their dividend yield is slightly below 4%, putting them largely in line with their peers among the big six in terms of multiples. CIBC, meanwhile, has been the best performer this year among their peers, posting a one-year performance of a gain of 63%, bringing the group average to 31%, beating the TSX by roughly 5% as per Captain Bruno. Guys, what can I say? Canada, the land of oligopolies. At least it's good for the shareholders. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, also let us know what you think in the comment section. This is the first time we have covered the big banks' earnings, and we're curious what you guys think. If you guys want us to keep covering these stories, let us know in the comment section. Thanks for watching, everybody.